I've made a fortune dancing on the graves of investors who believed that this time was different. It never is. The market is about to give a whole generation of disruptors and visionaries a very expensive, very painful lesson in the laws of gravity. You look around today in 2026 and you see the same hubris, the same blind optimism, and the same fundamental illiteracy that preceded every crash I've lived through since the 60s. Everyone is so busy chasing the next AI-driven real estate platform or some algorithmic promise of eternal growth that they've forgotten the only thing that actually matters. The numbers have to work. And right now, the numbers aren't just failing, they're screaming. If you can't see the cliff we're standing on, it's because you're too busy looking at your own reflection in the glass of a building that's currently worth 40% less than the debt held against it. I've been called a grave dancer for decades. People used to think it was a morbid title, something cynical. It wasn't. It was a recognition of reality. When the music stops and the lights go out, most people freeze. They wait for a bailout. They wait for the Fed to pivot. They wait for a miracle. I don't wait for miracles. I wait for the corpses to pile up so I can see which ones still have good bones. The tragedy of the current market is that people have mistaken liquidity for value. For 15 years, cheap money acted like a veil, hiding incompetence and masking the rot in the fundamentals. But the veil has been ripped away. Interest rates didn't just normalize. They corrected a decade of insanity. And in that correction, the distance between what an asset is worth on a spreadsheet and what it's worth in cold, hard cash has become a canyon. If you're standing on the wrong side of that canyon today, no amount of vision is going to save you. My philosophy has always been simple, though apparently simple is the hardest thing for Wall Street to grasp. It starts with the absolute law of supply and demand. It's the only law that hasn't been repealed by the internet. You can have the most beautiful, high-tech, environmentally platinum-certified office tower in the world, but if there are 10 other towers just like it and only 5 tenants who want to be there, your building is a liability, not an asset. We are currently witnessing a massive systemic failure to understand supply. For years, developers built because the capital was available, not because the demand was there. They built for the exit, not for the hold. They built on the assumption that someone even more foolish than them would come along and buy them out at a 2% cap rate. Well, the greater fool has officially gone extinct, and the people left holding the keys are realizing they've bought into a fantasy. You want to know why my 2026 prediction is chilling? Because we've reached the end of the pretend and extend era. For the last couple of years, the banks and the private equity shops have been playing a high-stakes game of musical chairs. They've been modifying loans, kicking the can down the road, hoping that if they just waited long enough, the world would go back to 2019. It's not going back. The structural shifts in how people work, how they live, and how they shop are permanent. The debt wall, that massive mountain of commercial mortgages that everyone's been whispering about, is finally hitting the floor. Billions upon billions of dollars in refinancings are coming due right now, and the math doesn't work. The income isn't there, the rates are too high, and the equity has evaporated. This is the moment when the grave dancer starts stretching his legs. In this business, you're either the hunter or the meal. Most of you watching this are currently the meal. You just don't know it yet. You're holding on to assets because you're afraid to realize a loss. You're listening to analysts who tell you that the long-term fundamentals are intact. Let me tell you something about the long term. In the long term, you're dead if you run out of cash in the short term. I've always been obsessed with downside protection. Everyone wants to talk about the upside, the blue sky, the potential. I don't care about the ceiling. I want to know where the floor is. If I buy an asset at a significant discount to its replacement cost, I've built myself a margin of safety. If the market stays flat, I win. If it goes up, I win big. If it goes down, I'm protected because nobody can build a competing product for what I paid for mine. That is the essence of being a contrarian. It's not about being a contrarian for the sake of being different. It's about being right when everyone else is wrong. Right now, everyone is wrong about trophy assets. They think because a building is famous or tall or in a prime zip code, it's safe. It's the opposite. The most expensive assets have the furthest to fall. The illiquidity premium that people use to talk about as a feature of real estate has turned into an illiquidity penalty. When everyone tries to exit through the same narrow door at the same time, the price doesn't just drop, it collapses. I'm looking at the markets today and I see a complete lack of asymmetric risk awareness. People are taking massive risks for pathetic returns. They're buying into growth stories in sectors that are fundamentally oversupplied. They're ignoring the barriers to entry or the lack thereof. If any idiot with a line of credit can build what you're buying, you don't have a business, you have a commodity, and commodities are a race to the bottom. I've always looked for the moat. In real estate, that moat is usually a combination of location, complexity, and timing. But today, the best moat is simply having the cash to survive while everyone else is drowning. Capital preservation is the name of the game in 2026. If you have the discipline to sit on your hands while your peers are out there deploying capital just to earn a fee, you're the one who will own the next decade. The urge to do something is the greatest enemy of the professional investor. I've made as much money from the deals I didn't do as I have from the ones I did. You have to be willing to look like an idiot for a year or 2 or 5 while the bubble inflates. You have to be comfortable being the only sober person at the party, because when the sirens start blaring and the cops show up, you're the only one who's going to remember where the exit is. Let's talk about the replacement cost, because this is where the real blood is going to be. In a normal, healthy market, you don't buy existing assets for more than it would cost to build them from scratch. That's common sense. But for years, we've been living in a world where market values were disconnected from physical reality. Now, as construction costs stay high and demand softens, we're seeing assets trade for 50, 60, even 70% below what it would cost to build them today. That is a siren song for someone like me. When you can buy a functional, cash-flowing asset for a fraction of its replacement cost, you have effectively eliminated the threat of new competition. No one is going to build a new office building across the street if they have to charge double your rent just to break even on their construction loan. That's how you build a monopoly on value. But to do that, you have to be willing to buy when the experts are telling you that the sector is dead. I remember in the early 90s during the RTC days, people told me I was crazy for buying up distressed apartment buildings and office parks. They said the American dream was over, that the economy was structurally broken. I didn't listen to the narrative. I looked at the supply. I saw that new starts had dropped to 0. I knew that the population was still growing, that people still needed a place to sleep and a place to work. I knew that if I could hold on through the liquidity crunch, the lack of new supply would eventually drive rents up. And that's exactly what happened. We're in a similar spot now, but with a different set of corpses. The office market is the obvious one, but the contagion is spreading. It's hitting the over-leveraged multifamily portfolios in the Sun Belt. It's hitting the last-mile industrial plays that were underwritten on the assumption that e-commerce growth would never slow down. The corpses are everywhere if you know how to smell them. The most dangerous phrase in the English language is, the trend is your friend. No, it's not. The trend is a siren that leads you onto the rocks. By the time a trend is obvious enough for the average investor to follow it, the smart money is already looking for the exit. I've always been more interested in the inflection point, that moment when the consensus shift is so extreme that the market overcorrects. We are at that point in several key sectors right now. The pessimism is becoming as irrational as the exuberance was in 2021. And that is exactly where the opportunity lies. But you can't capture it if you're obsessed with your quarterly mark-to-market. You have to have a long-term horizon, and more importantly, you have to have the stomach for it. Most people think they have a high risk tolerance until they actually see their net worth drop by 30%. Then they fold, they sell at the bottom, they de-risk right when they should be doubling down. Real estate isn't a game for the faint of heart or the thin-skinned. It's a game of leverage, and leverage is a double-edged sword that will cut your head off if you don't respect it. I've always used leverage as a tool, not a crutch. I want to know that even if my income drops by 40%, I can still service my debt. That's the margin of safety. If you don't have that margin, you're not an investor, you're a gambler, and the house is currently cleaning the tables. I see these young guys on social media talking about passive income and strategies like they've discovered fire. They've lived their entire professional lives in a declining interest rate environment. They think they're geniuses because they bought a building in 2015 and sold it for more in 2021. That's not skill. That's just being a passenger on a rising tide. Skill is what you do when the tide goes out and you realize you're the only one not wearing a bathing suit. The next few years are going to be a masterclass in operational excellence. You're not going to get bailed out by cap rate compression anymore. If you want to make money in 2026 and beyond, you're going to have to actually manage the assets. You're going to have to cut costs, drive occupancy, and find efficiencies that the previous visionary owners were too lazy to look for. You're going to have to be a businessman, not just a deal maker. The deal maker is a dime a dozen. Everyone wants to be the guy at the closing dinner drinking the expensive wine. Nobody wants to be the guy in the basement of a distressed shopping mall in the middle of a Tuesday afternoon trying to figure out why the HVAC system is failing. But that's where the money is made. It's made in the details. It's made in the unsexy parts of the business. I've always gravitated toward the unsexy because that's where the competition is the thinnest. If everyone is fighting over the glamour properties in New York and London, I'll be in the secondary markets buying the boring stuff that actually pays the bills. Because at the end of the day, $1 of cash flow from a warehouse in Indianapolis is worth exactly the same as $1 of cash flow from a penthouse in Manhattan. Only the warehouse costs me a hell of a lot less to buy. That brings me back to the concept of the grave dancer. To be a successful grave dancer, you need two things: a sense of timing and a lack of sentimentality. Sentimentality is the death of profit. I don't love buildings. I don't love companies. I love the math. If the math stops working, I'm gone. I've sold trophy assets that I spent years acquiring because the price was right and I saw the clouds on the horizon. People would ask me, Sam, how could you sell that? It's a landmark. I'd tell them, a landmark is just a building that's hard to renovate. You can't get emotionally attached to brick and mortar. It's just a vehicle for capital. If the vehicle is broken, you get out and find a new one. Right now, there are a lot of broken vehicles on the road, and the owners are trying to convince themselves that they can fix them with hope. Hope is not a strategy, it's a liability. The reality of 2026 is that we are seeing a massive transfer of wealth from the hopeful to the prepared. The corpses I'm seeing are the ones who over-leveraged based on pro forma projections that were never grounded in reality. They assumed that rents would grow by 5% every year forever. They assumed that exit cap rates would always stay low. They assumed that there would always be a wall of capital waiting to bail them out. They were wrong on all three counts. Now they are facing the reality of negative equity. When your debt is higher than your asset value, you are no longer the owner. You are a glorified property manager for the bank, and the banks don't want these assets. They don't know how to run them. They want someone like me to come in and take the problem off their hands at a price that makes me a lot of money. And that price is usually pennies on the dollar compared to what they thought they were worth 12 months ago. You see, the banks aren't in the business of owning buildings. They're in the business of renting money. When the money stops coming in, they panic. And when banks panic, that's when the grave dancer gets his music. We're seeing it right now in the office sector, but it's not just about working from home. That's a convenient excuse for a much bigger problem, functional obsolescence. Half the office stock in this country is effectively dead. It's not just that people aren't there, it's that the buildings themselves don't meet the needs of the modern world. They're zombie assets. You can't just slap a coat of paint on a 40-year-old floor plate and call it Class A. The cost to convert these things is often higher than the value of the finished product. So what happens? They sit, they rot, and eventually the land underneath them becomes more valuable than the structure on top. That's a corpse I'm watching very closely. But let's look at where the real surprise and the real carnage is happening. The multifamily market in the Sun Belt. For the last 5 years, everyone and their mother was a multifamily investor. They all read the same reports about migration patterns and job growth in places like Austin, Phoenix, and Nashville. They bid prices up to levels that defied logic, fueled by a delusion that rents would grow by double digits forever. They were buying at 3% cap rates with floating rate debt. It was professional malpractice. Now the supply is hitting the market all at once. Thousands of units coming online just as the economy is cooling and the migration has slowed to a trickle. Rents aren't just flat, they're falling. And that floating rate debt, it's doubled or tripled in cost. You have thousands of syndicators who are about to lose everything because they didn't understand the basic relationship between cost of capital and net operating income. They were playing a game of flip the script, and they ran out of pages. The opportunity here isn't just in buying the buildings, it's in buying the debt. I've always said that I'd rather be the lender than the owner when the world is ending, because the lender gets to decide who the next owner is. We are seeing a massive deleveraging event. The equity is gone. It's been wiped out by the rise in rates. The conversation is now between the senior debt and the mezzanine players. And if you have the cash, you can step into that vacuum and reset the cost basis. If I can buy a note at 60 cents on the dollar, I don't care if the building's market value is dropped by 30%. I've still got a massive cushion. That's downside protection in its purest form. It's about being the last man standing with a checkbook in a room full of people who only have excuses. Let's talk about the AI nonsense and the tech savior complex for a minute. Every time there's a new technological buzzword, the real estate visionaries lose their minds. They think that somehow blockchain or artificial intelligence is going to change the fact that people need a physical place to stand, sleep, and store things. It won't. It might make the leasing process slightly more efficient, or it might help you optimize your HVAC system, but it doesn't change the supply and demand of physical space. In fact, most of these prop tech companies are just another version of the burning cash model I despise. They have no path to profitability. They just have a high burn rate and a slick pitch deck designed to fleece venture capitalists. I look at these companies and I see more corpses in the making. The real winners in the AI revolution won't be the companies that use it to disrupt real estate. It'll be the data centers. But even there, everyone has piled in. The barriers to entry in data centers aren't the technology. It's the power and the cooling. If you don't control the power grid connection, you don't have a business. You just have a very expensive box of fans. The 2026 reality is that liquidity is the only thing that matters. We are entering a period of prolonged illiquidity. The private equity funds that promise their investors 15% returns are now gating redemptions because they can't sell their assets without admitting they've lost billions. They're stuck. And when they're stuck, they can't do new deals. That leaves the field wide open for those of us who didn't drink the Kool-Aid. I've always been a believer in the illiquidity premium. When everyone else is desperate for cash, your cash is worth double. That's how you get the asymmetric returns. You're not just buying an asset, you're buying someone else's desperation. It sounds cold, but that's how wealth is redistributed. The market doesn't have a heart, it has a pulse, and right now that pulse is thready. I see massive opportunities in the unloved sectors. Everyone is terrified of retail, but necessity-based retail, the grocery-anchored centers in the suburbs, is actually performing better than it has in 20 years. Why? Because the supply has been constrained for 15 years. Nobody has built a new neighborhood shopping center since 2008. The replacement cost of these centers is through the roof. If you can buy them at a 10% cap rate because some analyst in New York thinks retail is dead, you're making a killing. It's not sexy. It's not a trophy asset, but it's a cash machine. And in a world of uncertainty, I'll take a boring, ugly, cash-flowing strip mall over a visionary office tower every single day of the week. The same goes for industrial. Not the mega warehouses built for the giants who are now retracting, but the small bay industrial, the places where the local plumber, the local distributor, and the local manufacturer operate. These are the bones of the economy. The demand is fragmented, the supply is limited by zoning and land costs, and the tenants are sticky. That's where you find the moat. You want to be where the competition isn't. You want to be where the big money is too lazy or too snobby to look. My prediction for the rest of 2026 and into 2027 is simple. The big reset is just getting started. We are going to see a series of high-profile defaults, names you know that will finally shake the confidence of the remaining optimists. We are going to see blue-chip REITs forced into humiliating restructurings, and we are going to see a lot of growth analysts suddenly discovering that the laws of economics weren't disrupted by the internet. The people who will thrive are the ones who understand that real estate is a cyclical, capital-intensive, and operationally demanding business. We've had a 15-year upcycle fueled by the artificial stimulant of 0% interest rates. Now we're having the withdrawal. It's natural, it's necessary. It clears out the rot, the tourists, and the incompetents. If you're sitting on capital, don't be in a hurry to spend it. The first movers in a crash are often just the first people to lose their money. Wait for the capitulation. Wait for the moment when the seller isn't just willing to sell, but forced to sell by a bank that has lost its patience. That's when the price is right. And if you're already in the game and you're struggling, my advice is simple. Be brutally honest with yourself. Don't pretend and extend. If the math is broken, admit it. Don't throw good money after bad. The most expensive thing you can own is a hope that isn't backed by a real, tangible cash flow. Position your capital where the downside is protected by the replacement cost floor. If you can buy an asset at 40% of what it would cost to build it today, you have a massive margin of safety. Focus on the cash-on-cash return, not the internal rate of return, IRR projections. IRR is just a number you manipulate on a spreadsheet to justify a deal you want to do. Cash on cash is the reality of what actually hits your bank account every month. Demand a margin of safety that can withstand a recession, a tenant bankruptcy, and higher taxes all at once. If it can't survive that, it's not an investment, it's a prayer. Most importantly, ignore the noise. The headlines are designed to generate clicks, not profits. The experts on television are paid to talk, not to invest. The numbers are the only truth in this business. If you focus on the fundamentals, supply, demand, replacement cost, and cash flow, you'll navigate this crisis just fine. In fact, you'll do more than navigate it. You'll use it to build a legacy. The world isn't ending, it's just resetting. And for those of us who know how to dance on the grave of a bad idea, a change in the music is exactly what we've been waiting for. The grave dancer doesn't cause the crisis. He just ensures that the assets find their way into the hands of those who can actually make them work. So sharpen your pencils, throw away your pro forma fantasies, and get ready. The best deals of your lifetime are sitting right in front of you, disguised as problems, but you have to have the guts to act when everyone else is looking for the exit. Now If you found any value in this blunt assessment of where we are, do the digital equivalent of a handshake, hit the like button and subscribe to the channel. I don't give this advice for the applause. I do it because someone needs to remind you that gravity still exists. And if you think I'm wrong, if you think your visionary project is somehow immune to the laws of supply and demand, then tell me why in the comments. I'm always looking for a good argument, but don't bring me your vision or your feelings. Bring me the math. My team and I will be looking through them to see if there are any real investors left, or if it's just a bunch of people chasing ghosts in the rubble. Good luck. You're going to need it.